Hey everybody, and this week we're going to look at Kate's cards again for Chapter 12, the serial problem. And we have to do the statement of cash flows, which is an important element of the financial statements because cash is important and we want to know where cash is coming and going. That's an important way to understand the business's health. That being said, they give us some information and they want us to do the statement of cash flows twice. Once using the indirect method and then using the direct method. So you're going to get the same results. It's not that. These are just how you present it. One is the indirect method, the other is the direct method. They give us the income statement and they give us the balance sheet. Now, on the balance sheet, note that a lot of times you need the change. And when you need the change, just remember that this is a brand new company, so everything started out at zero. So if you wanted the change of accounts receivable, it went from 0 to 11,000. So it was a change of 11,000 as an increase. And I think that's all the information they give us, and we'll go from there. So on your template, the first method is to do the indirect method. So the indirect method will start out with net income. And then since net income is an accrual-based method, net income was not calculated on the income statement using the cash basis. That means there's a lot of non-cash information in the net income. And so what we want to do is we want to back it out, and then what we'll be left with is the cash impact from operations. So think about it. We're starting out with accrual-based profit, net income, and then we're going to back out the effects of accrual basis. So that's why it's called indirect, because we're going to start out with an accrual basis and then back out things that aren't cash related, and then that'll leave us with what was cash related. So first of all, we'll start out with the net income. Now I want to just do a couple just to help you get started. Right, so there's the net income, and then you want to back out things that are not cash related. So one of the things that's not cash related is the depreciation expense for the year. So we'll take the depreciation. Now, how did I get that? Well, you might say that, well, I looked at this right here, but you can also get it from the balance sheet. Since this is a brand new company, the accumulated depreciation was 0, and then it changed to $3,250. So that also shows you the change in the accumulated depreciation is going to be the depreciation expense. So 3250. Now, why do you add depreciation expense? Well, because depreciation is not cash. You don't write a check to some depreciation company. There's no such thing. Depreciation is an accounting expense. We talked about what depreciation means in a previous chapter. And it's never going to hit your cash. Since there's no cash impact, you're going to add back the depreciation expense. And what that does is, since the depreciation was originally taken as a deduction to net income, adding it back shows the cash impact. And then you're going to do this for the others that you need to do. Then you have your investing activities and your financing activities. I'm not going to go through each of these because I'll show you where you can get the process for doing these in the chapter. At the end of the year, you have a cash balance that should equal your balance sheet. See how your balance sheet is $17,004? We want to show where that came from. So this will end up being $17,004. Now the difference between the indirect method for Part A and the direct method for Part B is only in the operating activities. In other words, your operating activities are going to be the same number in total, but your way to calculate them is different. Now, the way to calculate your investing and finance activities will be the exact same. So once you do Part A, the investing and finance activities will be exactly the same. However, your cash collections from customers, and all this stuff here, the only difference between the direct and indirect method is the operating part, the operating activities part. So what does direct method mean? Well, that, if you think about the word direct method, is saying that you do it directly, you don't back into it. So instead of backing into it, we're going to say, well, what cash did we get? In other words, we want to look at the cash that came in and went out directly rather than taking the accrual basis and backing out stuff. So how do we calculate these? So there's some calculations that are needed for this. Let's look at those for a second. So we'll start out with cash collected from customers. So this is cash coming in other words, customers directly handing us cash. How do we calculate that with the information that we're given? One way to calculate it is just to count the cash coming in, but we don't have that ability on this case. So how are we going to calculate it with the information we're given? Well, we'll start with the revenue. So if you look on the income statement, you see the revenue. Now that revenue is not cash. It's not the same thing. But it is a starting point. So we'll start with the revenue, but then we'll remove any receivables. Why? Well, because receivables mean people owe us. So they haven't paid us, so we haven't received that cash. But we do want to include any unearned revenue. So we want to add that because unearned revenue means that someone paid us cash, but we haven't done the work yet. So that's how we'll go ahead and calculate the cash collected from the customer. So I need you to do those calculations and show me how you did those. What about cash paid for inventory? Well, you start out with the cost of goods sold. So that's going to be goods that we sold. But that's not what we paid for the inventory. That's just a starting point. So we'll start with that. Then we'll include any inventory, the increase in inventory. So we'll include that, but don't include any accounts payable. Why? Because a payable means that we haven't paid, hence the cash hasn't gone out. Finally, cash paid for operating expenses. So when you look at the operating expenses, start with that number, but remember that's on the financial statement. On the financial statements, we have accrual basis, so we want just the cash that was paid for it, the cash implications of the operating expense. So we'll remove depreciation, like we talked about earlier, the same reason. Depreciation is a non-cash expense. You never pay someone for the depreciation with cash. And then you add any prepaid insurance. Why do you add prepaid insurance? Well, because you paid for it. Even though it's not an expense yet, it's something that you paid for. And then you will remove the current liabilities. Again, liabilities mean we owe. We haven't paid for them yet. And so since we haven't used cash yet, we want to remove that from the operating expenses because those haven't had a cash impact yet. When you go in the chapter, there's a lot of help. You just have to go through the chapter and practice this. So if you look in chapter 12, so first thing they have the preparing the statement of cash flow using the indirect method. So if you go there, you'll see there's a video provided for you, and then there's a your turn, and again this will walk you through it as well as the U-turn will give you a video to show you how to do it. That's for the indirect method. To do the direct method, go down to the appendix, and when you click there, they have a walkthrough video. They walk you through in the textbook. And then you can also go through and look at the your turn as well as the video that's associated with it. It's really important that you go through the chapter for both of these before you attempt the problem because it'll make a lot more sense.